Welcome to This Week in the Markets. Today we'll be going through Ben Bernanke's antics at the Fed, events in Europe, Asia, and here in Australia. But before we begin, let's have a read of our disclaimer. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should therefore, before acting on the advice, if you choose to act, consider the appropriateness of the advice, having regard to your objectives, financial situation, and needs. We begin the week with the Fed announcing that it debated on the length of the QE program. Suffice to say, money printing won't be on forever and will need to be tightened eventually when the economy shows signs of booming. Funnily enough, this came out as a revelation to the market, and the S&P 500 had fallen almost 40 points on Monday, and might correct further. Since then, Ben Bernanke has also testified to the Senate Banking Committee, underlining his support for monetary policy easing and also Japan's fight against deflation. On day 2 of the testimony, the chairman stated that higher interest rates may signal a stronger economy and that the Fed's stimulus is working. Bernanke reinforced the increasing demand for homes, cars, and an improving housing market. Following this, core durable goods, which excludes transportation items, rose 1.9% from last month, beating forecasts of 0.2%. Pending home sales also increased by 4.5%, above the forecast 1.7%. The numbers sent the S&P 500 upwards from a low of 1490 to finish at 1515. Big Ben went on to say that the Fed will review an exit strategy for monetary easing. Good luck with that. In Australia, Reserve Bank Governor Glenn Stevens has provided confidence to bullish sentiments by stating that the bank is unlikely to intervene in the currency unless it is seriously undervalued. Seriously undervalued could mean anything, but we deduce that a range between 1.08 and 1.10 are areas of concern. Furthermore, the RBA has said that up to 34 central banks around the world are holding Australian dollars, and most valuation models suggest that the currency is overbought. Italy has gone back to elections, with Luigi Bersani and Silvio Berlusconi going head-to-head. After spending 2012 in the shadows, Silvio Berlusconi has provided tough opposition to the centre-left Democratic Party leader Pierluigi. Luigi has won the lower house by the smallest of margins, but the upper house has no majority, therefore neither party can form government. Parliament has to meet 20 days after an election and must begin formal negotiations with President Giorgio Napolitano on forming a government. European powerhouses Germany and France have reacted to the tension by urging the nation find a leader as soon as possible. Britain ended the week with its credit rating being downgraded by Moody's to AA1 just 1 hour before markets closed. The release expectedly caused short-term panic as the pound fell sharply in the last hour. Typically, we would expect this rating downgrade to push down the pound, the London Stock Exchange, British government bonds, and even have some negative effects on the euro and equities. However, weaknesses in the UK is already widely expected by investors, so the downgrade did not come as much of a surprise. In market sentiment, whispers of unease are also starting to take shape as the VIX rose from 12.08 on February the 19th to 19.28 on February the 25th. It appears that risk aversion is taking place as investors, traders, and everything in between switch from high volatility assets to safer, lower yielding assets. This is particularly evident in the yen strengthening all throughout February, however slightly, and also commodity currencies like the Australian dollar falling throughout February. The euro yen is also pushing its 121.6 support and could find resistance at 122.8. The pair has been making lower highs all throughout February. These specific pairs have not broken down from the decline on Monday, which means that they may be waiting for a catalyst that pushes these pairs over the edge, and this may be risk aversion, perhaps arising from the sequester. In Japan, a new governor has been appointed to head the Bank of Japan. Haruhiko Kuroda, who was the president of the Asian Development Bank, will head the central bank in its fight against deflation. Kikuo Iwata and Hiroshi Nakasawa have been appointed as deputies. The first policy meeting for the bank is scheduled for April 3rd to the 4th. In China, a number of provinces are setting lower growth forecasts in the wake of the government's efforts to slow down provincial expansion. The move comes on the back of rising debt levels. And that brings us to the end of our presentation and the week. On behalf of Trading Pursuits, we would like to wish you happy trading.